Good morning. Good morning, good afternoon. We'll start in just a moment. Hello and welcome to this week's MoneyFit Live webinar. My name is Todd Christensen. I am the Education Manager at MoneyFit by DRS. I'm glad to have you join me, whether you're doing so live or whether you are viewing this at a later time. Today's topic, the title is 3 Dangerous Decisions That Keep Us in Debt, and you have to read it properly, forever. Many of you who have seen the old movie Sandlot know that that quote there. If you haven't seen it, highly recommend it. Love the show. But there are three decisions that we make financially that will keep us in debt for our entire lives if we're not aware of it and don't decide, and unless we decide to change our behavior and our habits. So let's go ahead and get into this. What we're going to do is go through a few questions one at a time. And those questions, multiple choice, just to make it easy, will form the basis of today's discussion. So, understanding debt. First of all, what is the average U.S. household credit card debt? In the U.S., what is the average household credit card debt? Is it $6,000, $8,000, $10,000 to $12,000, $14,000 to $16,000, $18,000 to $20,000? Now, over time, these numbers are going to change. Generally, they will go up. With inflation, they'll go up, but there are sometimes, particularly right before recessions or depressions. Hopefully, we don't have to go there again. They will go up. During recessions and depressions, actually, credit card debt goes down because we finally realize, hey, I don't need to be putting all this spending on debt, and we cut way back. But here's the answer. It's kind of cheating. There is not one right answer. It just depends on how you look at the term U.S. credit card debt, household credit card debt. If you're talking about all U.S. households, then it is in the $6,000 to $8,000 range currently as of 2019. Not all households have a credit card. So if you only then count households that have a credit card, it's going to be in the $10,000 to $12,000 range. Not all households that have credit cards will carry a balance. In fact, only about 60%, about 60% or more, depending on the year, will carry a balance on their credit card from month to month. So if you only count households that carry a balance on their credit card, it is in the $14,000 to $16,000 range. So if you have a credit card and you carry a balance, chances are it is quite high, which is what we're seeing now. That is a huge, and if you think about it, the average credit card interest rate at the moment is about 17%. Historically, in the last 2 decades, it has fluctuated between 14 and 16%. We're actually a little high at the moment, historically. And so 14 to 6, let's say $15,000 a month, if that's how much you're carrying in your household, even if it were at 10%, that's $1,500 a year you pay in interest, just in interest. So at 16%, 15%, it's going to be $2,200, over $2,200. At 17%, you're probably looking at close to $2,500 a year just to pay the interest, or for the fee, basically, for the privilege of borrowing money, buying something that we didn't have the money to pay for. That's where we're at. I apologize for the alignment here. Next time, if you do another one of these, promise it'll be fixed. 2, what is the average student loan debt for the 2019 for a 2019 graduate with a bachelor's degree in the U.S.? Is it 10 to 20, 20 to 30, 30, 40, 40, 50, higher, lower? What do you think? The reality is, it is in the $40,000 range. When I started doing these classes back in 2004, the average graduate from college with a bachelor's degree had about $17,000 of debt. 17. That was average. It's gone up over $1,000 a year until here we are 15 years later, we're in the $40,000 range. That's a lot of debt. The rule of thumb, by the way, if you want to know how much is too much, you can't look at well, what school are you going to? It doesn't matter what school you go to. It does not. People think, well, if I go to a nice school, I have to expect to get into more debt. It doesn't matter. You've got to ask this question: what am I going to earn coming out of college my first year? With a degree, with a 4-year degree, and unfortunately, not everybody finishes. That takes out student loan debts, and those who don't finish end up having to pay that student loan debt, and they don't get the benefit of a degree to increase or boost their earnings. Not everybody with a degree earns the same amount. Not everybody from even graduating from the same school will earn the same first year. Ask yourself, what is it that I can realistically expect to earn my first year out of college? Do some homework. Don't accept the median income for that degree, because that includes people who are probably 15, 20, 30 years into their career. So the rule of thumb is don't borrow more than what you expect to earn your first year out of college. If you can stick to that rule of thumb, you should be able to pay back your debt as agreed in the standard term of 10 years. Otherwise, you're going to struggle and have to extend it. You may have to extend it out at 15, 20, 25 years, which means you may end up paying 50% or more back than what you actually borrowed. All right. Why do most individuals file for bankruptcy? Now, this is based on a survey that we've done here for people going through bankruptcy. We are providers of the bankruptcy certificates required for anybody going through bankruptcy, personal bankruptcy. And we asked them, what is it that caused you to consider bankruptcy? These are the top 4. These are the top 4 reasons. Which one do you think is the most common reason for filing bankruptcy? Medical expenses, poor money management, divorce, or job loss. The media always makes a big deal about medical expenses, and I'm not going to discount the extreme amount of medical debt that some people can have, or that our insurance system is broken and so it's so fragmented. That's not the point, though. Medical expenses actually is not number 1. It's not even number 2. It's number 3. Number 4 is divorce, about 10%. Medical bankruptcy was about 20%. First, by far, was job loss. People losing their job, not having enough in savings to cover expenses, and so they go into a lot of credit card debt during that extended period of job loss or without income. And even once they get that job back or another job, they try and deal with their credit card debt and any other debts. So they've gone to collections, and after 3, 4, 5 months, they get to the point where they realize that bankruptcy is about their only option. So that's about 40% of what we found. It was a little higher than that, about 50% during the Great Recession of the late 2000s. But typically it's about 40%. We've seen a low about 35% some years. Poor money management has always just stayed pretty steady, right about 25%. 1 in 4 bankruptcies, just overspending, poor use of credit cards. Number 3, let's talk about this fatal mistake now. It is related to poor money management and job loss, both actually. It is that 60% of Americans are living paycheck to paycheck, just no money in the bank. 28% have no money in the bank at all. 60%, everything that comes in on payday, by the next payday, it's all gone. There's nothing of value to show for that money. That's living paycheck to paycheck. 3 out of 5 American households are doing that. 3 out of 10 have zero, virtually zero, in their savings account. Now, if we go back here, you look at this, poor money management, 25%. That could have been a huge help. Job loss for those households that had sufficient income, 2, 3, 4, 5, 6 months of housing and transportation and cell phone and insurance expenses in a savings account, that would have been able to save them, keep them from going to bankruptcy. So, number one fatal mistake: no savings. No surprise. You hear it over and over again. Financial experts will say the number one habit that you've got to get into if you want to be financially stable and successful is to pay yourself first. Make it a habit of paying yourself first. Put money into savings. Put money into investments. There will always be something happen, whether it is job loss, whether it is a medical issue or an emergency, car breaks down, whatever it might be, or divorce, or being widowed, which was number 5. Savings will not guarantee that you can get through that, but it will minimize the impact that it has on your financial life. So that's fatal mistake number 1: no savings. How do you fix that? Commit to saving something. I don't care if it's $1 a month or $5 a month or $500 a month. Tell yourself today, I'm going to start putting something into savings. There's so many apps for that. Just look it up. You don't need to do anything fancy. So consistency is far more important early on than an amount. Like I said, I don't care if it's $1 or $5. Just do it regularly. All right, question number 4. How much do minimum payments pay down your debt? If you get in a credit card debt and they ask you for a minimum payment, how much of that is actually going to pay down your debt? And because you know that some of it's going to pay interest. Is it going to be 1 to 2%, 4 to 6, 8 to 10, 12 to 15? So this is something that I didn't understand when I was young. I assumed that if I made a payment, most of that would go to paying down the balance. First time I got a credit card and maxed it out, 36 hours, I sent off a $50 monthly payment. That was the minimum payment, $2,000. And after the payment cleared, a couple of days later, I went to buy some groceries and just tried to buy $15 of groceries. I assumed I just made a $50 payment. Certainly I can buy $15, $20 of groceries. Declined. Because all but just a few dollars of that went to interest. But $5 was about all that went to that came down. So $2,000, I still owed $1,995 basically. So only 1% is the amount that a minimum payment will pay down. So that if you only make minimum payments, you might think, well, it'll take me 100 months to pay off, right? No, that's not 1% of the current balance. That's 1% of each month's balance. So every month, if you are making minimum payments, the minimum payment goes down, it gets smaller and smaller, and the 1% gets smaller and smaller. So actually it takes 15 to 25 years to pay off. Anytime you can send extra payments, you're going to be better off. And that is fatal mistake number 2, believing that you can do okay or get by only making minimum payments on your credit card debts, store cards, even home loans and car loans. If you only make minimum payments, you're going to end up paying more over time for interest and put yourself at higher risk for troubles. So how to deal with minimum payments? Pay more. There's that still, it's like the 60-40 rule. There's 60% of people are living paycheck to paycheck. 60% of credit card holders are only making minimum payments or paying only a little more than minimum payments every month. Only 40% are actually paying off their credit card debt every month. So if you use a credit card, be among that 40%. You want to be an exclusive club? Pay off your credit card debt every month. You want to be an exclusive club? Put money into savings every month. Those are 40%. That's pretty exclusive. So more exclusive than 60%. Okay, so how do you deal with that? You just pay, you only borrow what you can pay off every month. In fact, if you're using a store card, you go in to buy some clothing, jeans, shoes, whatever, don't even leave the store without paying it off at the customer service desk. You never want to leave the store owing money, because you will forget about it before you get the next bill, and you'll spend that money elsewhere, and then you'll get stuck into that minimum payment cycle. So, in fact, I often recommend don't carry a credit card, period. People say, well, what about I have to have it for emergencies. We live in an age of a cell phone. The idea of being stranded out in the middle of nowhere and not being able to ever get help except having a credit card, let's deal with reality. You are so much more likely to max out your credit card and use it to buy things that you can't afford than you would ever be getting stranded somewhere in an emergency like that. If you had a real emergency, that's what a cell phone is for, and you call your family member or friend and have them drive down 20 miles or 40 miles or whatever with a credit card, or you call your bank or credit union. You get it taken care of that way, your credit card company. Don't carry a credit card. If you want to use it to build credit, that's a whole other class, but just put your cell phone bill on it once a month, or put your Netflix or Hulu or any other regular monthly payment, just one, and then pay it off every month. It doesn't have to be huge. You do not. There's a myth out there that you have to buy all this stuff and you have to carry this huge balance. Get real. If that doesn't sound right to you, it's because it's not. You only have to use it once a month for something small. All right. Question 5, who helps consumers pay off their debts dollar for dollar? 100%. Which one of these? Is it a debt negotiator, a credit counselor, a state lottery? Laugh, laugh. Bankruptcy attorney. Each of them deal with debts, or they might tell you that they're going to help you with debts. Please don't play the lottery. It's an attack on people who are bad at math. Okay? Take it for what it is. That is what it is. If you're not understanding how lotteries work, you're not good at math, you should not be playing them. And the people who know what it is won't play them because they understand them. Terrible, terrible odds. You're going to lose 100% of your money. You're going to win $5, $10, $20 every once in a while. Yeah, that's true. But you know what you do with that? What everybody else does with it is they go back and buy more lottery tickets, and they end up losing that as well. Somebody's got to win, but it's not going to be you. Please just accept that and use that money wisely to do something better with it, more that's actually going to build your financial future. Sounds harsh? Sorry, I'm going to tell it like it is. Debt negotiators or debt settlement companies, they're the ones that will say, we can get you out of 50% of what you owe, we'll damage your credit, and only successful in the single digits as far as studies that I've seen. Bankruptcy attorneys, of course, they will help you get out of all of your debts. You're not going to repay those debts. Even if you're in a debt Chapter 13 repayment plan, you're only going to repay back typically a few percentage points of your total debt. Credit counselors, nonprofit credit counselors, go to fcaa.org, Financial Counseling Counseling Association of America, sorry, and NFCC, the National Credit Counseling Foundation. NFCC.org, FCAA.org, you'll find a nonprofit credit counseling agency you can trust to help you pay off 100% of your debts in 5 years or less at very highly regulated monthly fees. So you can trust those organizations. I would. So fatal mistake number 3 is playing the debt shuffle, because besides those 4 options, a lot of people say, well, I'm going to use this credit card and transfer the balance over to that credit card, or I'm going to get a home equity line of credit and pay off these credit cards over there, and then I only have to deal with that one. That sounds like a great idea, because often this is at a lower interest rate over here. What the reality is, though, you pay off all these credit cards, 70% of people who do this, and maybe you would be among the 30%, fine. But most people who are among the 70% don't think they're there until this happens. They pay off all these credit card debts, and now they only have this one debt. And they're like, see, it's so much easier now. A month later, 2 months later, 3 months later, they're looking over, something else comes up that they want to spend money on, they want to buy an activity or a product, and they don't have cash for it. They look, I'm just going to use this credit card this one time. And they do that, and then they do it again and again and again. And within 2 years, less than 2 years, 70% of people who transfer debt from credit cards over to another credit card or to a home equity line of credit have that new debt that they've just transferred over, plus the new debt on the old credit cards that they've used, and build back up right to where they started. So avoid the debt shuffle. It is not getting you out of debt. It is just shuffling it, and it's not a plan to get out of debt. You've got to make changes in the way you spend and force yourself somehow through a plan, through a setup, whether it's through yourself or through a nonprofit credit counseling agency, where it forces you to pay off your debts every month and not getting into any more debt. So that's what we're talking about, is you've got to commit to it. If you're going to do it, you're going to have to push, you're going to have to exert some effort. It's easy to get into debt, really easy to get into debt. You can't get out of debt without having to put forth some effort. Anybody who promises you an easy way of getting out of debt is going to put you even further in the hole. So if they say, oh, this is easy, don't worry about it, there's no fees, you're going to come out smelling like roses. No, you can't end up smelling like roses when they throw you in a dung pile. So please understand, it's going to take some time to deal with it. But the sooner you get started, the sooner you can get done. Whether it's 2 years or 3 years or 5 years, get started now. Okay, so here's, if you want to try and pay off debt on your own, we've talked about the third-party debt helpers. Here's how you do it on your own. You want to, I call it shooting hoops. You want to line up your hoops. Let's look at all the different debts that you have. Some of them are huge debts, small payments, relatively. You think about home loans, or maybe even car loans, although those are usually pretty large. Some of them are the large debts and large payments, which is more likely your car loan. Some of them are small debts and small payments, maybe a store card, or you got some credit cards. And you're just making minimum payments. And you don't know, is this how it works? It doesn't feel like I'm making any progress. And you barely are. If you are continuing to use those, first of all, you're not making any progress. You use it, you make the minimum payment, use it, make the minimum payment. You're either same, or it's getting worse. So start by lining them up. Align the hoops. You can do it this way. This is called the debt avalanche method. Get rid of your debt using the debt avalanche method. You put the highest interest rate, the account with the highest interest rate first at the top. There is nobody in this world that can tell you with a straight face and that knows what they're talking about that there's a better way of paying off your debts than the debt avalanche. You're going to save more money. You're going to be out of debt sooner. In many cases, only might be a month or 2 or 3, but in those cases, you still are probably saving hundreds, if not a couple of thousands of dollars in interest. So let's set up your debt plan. I'm going to pay off this debt first, highest interest rate first. Make minimum payments on everything else. Any extra money that you can pay, you go to that one on top of your list. Like I said, debt avalanche. Once that top one is paid off, you add that monthly payment. That's in this situation, the purple account, whatever you were sending there, you add that monthly payment down to the next one, to the pink one. Now you got 2 months worth or 2 accounts worth of payments going to that one account, and that accelerates that repayment of your next account. Once that one's paid off, again, you take that same monthly payment and you roll it over to the next one on your list. And now you have even a bigger monthly payment going to that green account, and you just keep doing that until now you've got this huge payment going to the silver account there, and you're going to get paid off on that last one, that light blue one. You're going to pay it off in a matter of a couple of months, very quickly. That's a debt avalanche. It will save you more money and have you out of debt sooner than any other account out there. Anybody who tells you otherwise is selling you a load of whatever you want to call it, because you have to focus on the highest interest rate first. Now, there are other options. Maybe your goal is not to get out of debt fastest. Most people it is. But if you look at it this way, You want to, let's say in a year or two, you want to buy a home. So you want to build or rebuild, typically, rebuild your credit rating as fast as possible. Then you're going to focus any extra payments on the newest account first, because the credit rating system puts more weight on newer accounts and new activities than it does on older accounts, things you had open a long time. So if you had a brand new account and an old account, they both have the same amount of balance on them, focus on paying down the newest one first. We call that the debt landslide. That is one that name we came up with, and it will help you build your credit faster than any other method. Paying down your debts just generally will improve your credit, but paying down, accelerating newer debts will build your credit faster. Now this is the debt snowball. This is the one that I'm kind of referring to when I'm saying if anybody tells you that there's a better way, there is no better way to get out of debt faster or saving you more money. The debt snowball, it can be appropriate for some people. The whole idea here is, pay the lowest balance first. Focus on that one so that you can get a quick early win. And that can give you a little motivational boost. There are some studies that will say, hey, it keeps you motivated. Some people, not all. And so you have to ask yourself, do I really need that motivation, or am I committed? Who this debt snowball method is for the middle to upper middle class that just has tended to overspend. And you're tired of overspending. You say, I got to get out of debt, but it's going to take me years. And I feel like I need to see progress. And so that's what the debt snowball does. You can pay off maybe that small clothing store account in 1 month. And you say, hey, yeah, one monkey off my back. Who's next? And you pay the next one and the next one. What I would recommend doing if you're going to start with a snowball is do it. Go ahead. Start it that way. But after paying off one or two, refocus and start working on the avalanche or on the landslide, whichever your goal is. There is no, the goal of the avalanche is save as much money and time as possible. The goal of the landslide is build your credit as fast as possible. There is no goal of the snowball other than just stick with it. There's another study that I see and that I put a lot of weight that I believe is quite accurate. And it says that motivation doesn't come from the actual method. It comes from your belief in the method. If you believe that the snowball method is the only one that will work for you, then of course it's going to be the most successful. If you believe that the others will work for you better, you'll be more motivated to stick with those. So find the one that you believe in and stick with it. And then there's this one, what I call, we came up with this year, we call it the debt cascade. You can't come up with any extra money because the other threes really rely on coming up with some extra money to send to the top, the debt on the top of your list. The debt cascade starts with whatever you can afford today. Here's my minimum payments. That's all I can come up with. I can't come up with any extra money. So it just feels like I'm not making any progress. I'm just going to pay the minimum payments. Problem is, if you make the minimum payments, again, it's going to take you 15, 20 years because those minimum payments that they ask for keep coming down over and over and over every month. It just less and less goes to paying down your debts. So take today's minimum payments and that becomes your new monthly payment. No matter what they ask for next month, if they ask for $1 less or $5 less or $50 less, you're going to stick with this monthly payment. And after 6 months, you're going to be sending already $30, $40, $50, $60 more a month than what they're asking for. At that point, you can ask yourself, okay, am I ready now to switch to the avalanche or the landslide? But if you start with the debt cascade, and if you want, you can just stick with it. The other three methods, sending an extra $25, $50, usually can bring your credit card payment down from 15 to 25 years all the way down to about 3 years. A little less than 3 years for the avalanche, right about 3 years for the snowball. If you want to go with only the cascade and stick with it the whole time, you'll still be out of debt in just 4 years. But if you can, start moving it toward either the avalanche or the landslide. Okay, and then really all you have to do is just keep going, make a commitment. Report to a family member or close friend that you can trust that say, hey, I'm getting out of debt. Every time you see me, ask me how I'm doing. And so that you could say, look, I know that my balance is down $200 this month, or I owe $1,000 less this month than I did last month or 2 months ago. So keep going. Follow up. Keep learning. If you think you already know everything, then then I'm kind of worried. But the reality is you're taking this class, so I'm really confident that you are going to make some progress on this. There are people that will not listen to anything that anybody else says. They already know how everything works, apparently. You're not among that. You are teachable, and you're going to learn what's best for you, and you're going to keep learning. Take this. You've taken this class. Look at some of the other classes that we do. Talk to a professional if you need to. Give us a call. Our toll-free number is 800-432-0310. Moneyfit.org is our website. We're never going to charge you if you want to call and just ask some questions and get some opinions and get some guidance. We don't charge for that. So give me a call. Education manager here, Todd Christensen. I'll look forward to hearing from you. We already talked about the third-party options, non-fault credit counseling, debt settlement, bankruptcy. Here's how you change. This is based on a theory that really can be effective. Picture where you want to be in a year or 2 or 4 years or 5 years or 10 years. Where do you picture your future? What do you want it to look like financially? How's it going to make you feel to be debt-free? And then consider where you are today. You feel that difference? That difference is what creates discontent. And it's the discontent that created by the difference of where we want to be and where we are now. That difference, that discontent is what motivates us to make change. So it's okay to feel that you're not where you want to be. What are you going to do to improve that? What are you doing now? What do you plan on doing? And tell yourself, I'm going to change. This is what I'm going to do. I'm going to become debt-free in 2 years or 5 years or 6 years. And then take one step. This is the key. If you don't do this, nothing else matters. Take one step now. As soon as you're done with this webinar, what are you going to do? Are you going to call your creditor and ask for a lower interest rate? Are you going to call a debt management company? Are you going to call a bankruptcy attorney? Are you going to call a friend or who's an accountant that you've relied on as a financial mentor? Do something, anything, but do something. If you don't do it within the next 24 hours, you won't do it at all. This will be a waste of your time. I don't want it to be a waste of your time. I want you to experience the exhilaration of paying off your debts, paying down your debts, and being debt-free. So do one thing right now, just today. Now, if you need a certificate of completion, go to bit.ly/MFL-3. That's MFL stands for Money Fit Live. So bit.ly/MoneyFitLive, MFL-3. Use for the passcode EVER819. No spaces, no dashes, no caps. EVER819. And you'll get your certificate emailed to you with your name on it immediately via email. Thank you for joining me today. If you ever have questions or anything we can do to help you out financially with any counseling or coaching or guidance or just to answer some questions, we'd love to hear from you. Hope you have yourself a great day, and we'll see you again at another Money Fit Live the next Thursday.